afternoon, or good evening, wherever you are at in this world. It's your girl, Shirley Nichols. I am here with Mortgage Money with Shirley. We are streaming live. We are streaming live right here in the Morris Media Studios in Los Angeles. And you can find this live streaming podcast. You can find it on my YouTube channel under Shirley Nichols. You can find it on my Facebook page, my personal and my business. Personal Facebook page, Shirley Nichols. Business page, Mortgage Money with Shirley on Facebook. Or like I said, subscribe, like, and follow on my YouTube channel. Shirley Nichols is where you'll find this podcast. We're streaming live right now, and we are on episode 24. Episode 24, y'all, it is A.R.M rates or refinancing. A.R.M rates and refinancing. We're going to talk a little bit about A.R.M rates. What is that, Shirley? Adjustable rate mortgages. We're going to talk about that, okay? But right now, again, I just want to say hello, welcome. Please go ahead, tag, invite some of your friends, family members, co-workers, neighbors, enemies if you have to. Hey, listen, we want to educate and talk to everyone on this holiday weekend. So I hope that you guys are going to have a great, fantastic holiday weekend. Memorial Day is on Monday, and I hope you all are remembering our veterans and doing all that we can do to celebrate and honor them. So again, it's your girl, Shirley Nichols. You're tuning live right now, podcast Mortgage Money with Shirley. And we're going to jump into episode 24, y'all. And before I do, because I always forget, let me go ahead and give you my NMLS number because, of course, some of you all might be wondering, does she really know what she's talking about, y'all? Of course I do. I've been doing this business for over 28 years, and my NMLS number is 105989. Now, why do you think that NMLS, why do you think that number is important? Well, it just gives you the credibility of knowing I am licensed to do what I do in this business. Again, I'm a mortgage broker. I'm also a realtor, a real estate broker as well. So if you have any questions, comments, or concerns, you can leave them on my Facebook page or DM me or YouTube comments, whatever you want to do, because at the end of the show, I am going to go ahead and give you my cell phone number, okay? At the end of the show. So that means stay tuned to the end of the show if you have any questions or comments or concerns, okay? So let's get into it. Episode 24, y'all. It's the adjustable rate mortgages or refinancing, and let's talk about it. So, like I said, I've been doing this for years and years and years and years and years and years. I have not always talked about adjustable rate mortgages. There was a period in time in this mortgage industry, there was a period in time where adjustable rate mortgages really kind of matched the fixed rate. So what are we talking about here? With the A.R.M rate, there are different indices that will allow you to have an A.R.M rate at a fixed rate for a certain amount of time. So for a certain amount of years. And normally in a normal market, adjustable rate mortgages tend to be lower than the 30-year fixed or the 20-year fixed. Not so much as a 15-year fixed or a 10-year fixed. And yes, believe it or not, there are some clients I have closed that had 10-year fixed rate mortgages. So normally your 30-year fixed rate, your 20-year fixed rate, or even your 25-year fixed rate mortgage is going to be a tad bit higher than your adjustable rate. And they call them adjustable rates for a reason, because they're only fixed for a certain amount of years. Typically, you may see a 3-year fixed rate, a 5, a 7, or a 10-year. So what does that mean, Shirley? Well, if you were going to do a 3-year fixed rate, that's where you're going to see the lowest rate of all of the adjustables, just about. Out of all the adjustable rate mortgages, typically that 3-year fixed rate is typically about the cheapest one. When you get into the 7 and the 10-year, where the fixed amount of time or that fixed rate is allotted for that certain amount of time, when it's into the 7 years and the 10 years, then that adjustable rate gets a little higher. And like I said, it used to be a time where those adjustable rate mortgages were comparable to a fixed rate. So we just really never even, talked about it as much. But there is a need for adjustable rate mortgages. Why, do you ask? Right now in this market, adjustable rate mortgages are about 0.25% lower than the 30-year fixed rate right now. So with rates doing what they're doing right now, and like I said, I don't like to refer to the interest rates as high. If you've watched my other previous podcast, I've often told you guys, I started out in this business selling double-digit interest rates. And I know you're thinking, what? No, you can't be serious. But I'm just that serious. We used to when I first got started. Okay, we're talking 28 years ago. When I first got started, we were selling money, we were selling mortgage rates in the double digits. That's just what we did. That was the norm. And I'm not talking the low 10% or 11%. I'm talking 13, 14, 15% rates. That's what we did. So when now we look at the market and, oh my gosh, Shirley, these rates are so high. I'm thinking, no, they're not so high. So, and I've said this on previous podcasts, the rates are probably where they should be for now. I know there's been talk with what the government is trying to do and what the chairman of the Federal Reserve Bank, Jerome Powell, is trying to do, is trying to stop the recession that may be forthcoming, or he might be trying to force us into a recession, but it's not predicted to be anything like we've had before, like in 2008 when the market crashed. So what we're looking at is interest rates are a little higher, okay? They're not high. Don't beat me up, don't send me any hate mail, but they're not high, they're higher, okay, than what we had in these last previous years during the pandemic, right? So again, like I said, what you are seeing in the market is, yeah, there's rates that are, mid 5% range, okay, on your 30-year fixed. And depending on your credit score, I've talked about this on previous podcasts, depending on your credit score, depending on how much cash you need to borrow off of that value of that property and what you owe, what we call the loan to value, depending on your loan to value, all of these things and your debt ratio, how much income you're bringing in versus what's on the credit report. Okay, I'll talk about that here in a second, but what the income coming in versus what's going out on the credit report, your debt to income ratio. So those three main factors really kind of contribute to what sort of interest rate you're going to get, whether it's in the mid fives, low fives, or the high fives touching on 6% in today's market, right? So you've got your FICO score to think about, your loan to value, and your debt to income ratio, okay? These three components kind of comprise what you're looking at for rates. But like I was saying, the 30-year fixed rate today, mid fives maybe, low end fives if you can, but the A.R.M rate or the adjustable rate mortgage is about 0.25% lower than that. Yeah. So now, when you're thinking about adjustable rate mortgages, who are my clients that I deal with when it comes to adjustable rate mortgages? Typically, that's the client who knows that they're either not going to stay in that house for very long, that perhaps they're thinking of selling in the near future. Okay. Or it's the client that says, oh, well, I'm more of a fan of an adjustable rate mortgage because I'm going to do the one for the 5-year period or the 7-year period. And as statistics will show, and history repeats itself. And like I said, I've been doing this business for a long time, but what you typically see is once you become a homeowner, what you typically see is the refinance train chugging along, right? And about every 3 to 5 years, somebody's refinancing. So you have that client that says, oh, yeah, I know I'll probably be selling in about 3 years or 5 years. I know I'll probably want to refinance in about 3 or 5 years. And right now is a very good market to understand that, because if you think that rates are high, but unlike me, and I think that the rates are higher than what they used to be, well, just know that this is a cyclical market, right? It goes in cycles. So it's constantly moving up, down, up, down. It's a cycle. So if you think that the rates are high right now, guess what? And it probably, and don't quote me on this because I have no crystal ball, and I do not know, but predictions and forecasts will say that in about 18 months or so, maybe 18 to 24 months, rates will start to go back down, under that 5% range. So if you feel and you are confident and know this to be, kind of what the the forecast may hold true, then you might want to think about doing an adjustable rate mortgage if you have to refinance or if you're in the purchase market, if you're looking to buy a property right now. And if you're going to use what the forecast or the prediction might say, in about 18 to 24 months, rates will go back under that 5%, then adjustable rate mortgage may be for you. And like I said, there's a 3-year fixed rate, there's a 5-year, there's a 7, there's a 10, right? And so now let's talk about this. So what happens, Shirley, after I want to do an adjustable rate mortgage, you sign your loan papers and everything's a go, right? If you do that 3-year fixed period, right? And that's a 3-year ARM. That's what we call it in the business. It's a 3-year ARM. Let's say you do the 3-year ARM. So what happens is they give you the lowest rate possible on that index, right? They give you the lowest rate on that 3-year term. And they say, okay, for 3 years, the first 3 years that you have this loan, your rate is going to be this. So let's call it, and don't quote me on this because I'm not going to quote today's rate on a 3-year ARM, but let's just say that for an example purpose, that today's 3-year fixed rate on an ARM is at 5%. So the first 3 years of your loan, your rate will be at 5%, and so will your payment. Whatever your payment is at that 5%, that'll continue for 3 years. And then you might say, well, what happens next, Shirley? I don't know. And truth be told, we don't know. Because if the market changes drastically and your interest rate goes up, then yes, your interest rate will go up. However, if the market rate drops and changes below that threshold, right, your rate will be whatever the rate is that you signed up with, okay? So just know that. It's kind of, like I said, it's for that particular client that knows what they want to do. So typically what you'll see is after that 3rd-year fixed rate period is over, a lot of clients end up refinancing out of that 3-year fixed rate, and maybe they'll get into a 20 or a 30-year fixed rate, okay? Now, there is a cap, okay? Let's just say that, yeah, you don't do anything with your 3-year your 3-year ARM rate. Okay, let's just say the market shifted, and the rates went up a bit, right? Because there's a cap that you cannot exceed 1% each year. So if your rate started at 5%, you can't go over 6% that first year, and so on and so forth. There is a cap on how much of an increase that these rates can get to on the adjustable rate. So you see, if you started out with a 5%, and the rate in the market on a 30-year fixed rate or even on a fixed rate period went from 5% to, a 7%. Your rate caps on that adjustable rate at 6. It doesn't go to 7. It can only go up 1% each year. Remember that. Okay? So that's another pro of doing your adjustable rate mortgages. There's a lot of pros to doing these ARM rates, and there's a lot of cons, right? There's 50-50 on each side. So you have to determine what's best for you, right? And that's why sometimes clients don't necessarily go with the 3-year. The majority of the clients that I see doing adjustable rates, they either do the 5 or the 7. Because like I said, the 10-year really doesn't do a whole lot. If you do a 10-year fixed rate, it's a little comparable to a 30-year fixed rate. So a lot of clients just say, instead of doing a 10, having it fixed for 10 years, why not just do the 30? Because the rates are real comparable once you get into the higher 10-year ARM rate and some of the 7-year ARM rates as well. Okay, and that's for this market in the year 2022. Like I said, in previous years, adjustable rate mortgages were the thing as well because the rates were a lot lower than the 30-year fixed rate or the 20 or 25-year fixed rate, right? Those rates were lower on the adjustable rate side, but again, they weren't low enough to make my clients jump out there and say, hey, I want this adjustable rate versus the 30-year. Back in the day, adjustable rates were a trend. Everybody wanted them because again, they tended to be a lot lower than 0.25% difference, right? And right now in today's market, that's what you're kind of looking at is about 0.25% lower than the 30-year fixed rate. However, again, a lot of people are starting to come over on the ARM rate side because they want their rate, as low as they possibly can go. And then they'll think about refinancing later. So let's talk about this refinancing business, right? I mentioned the three components of what really kind of comprises these interest rates and the calculation of how they get to be, someone has this rate and then I have this rate and so on and so forth. The three components that really kind of trigger what kind of a rate that you'll end up with is, again, your FICO score, your loan to value, and your debt to income ratio. I want to touch on this third point about the debt to income ratio because that's where believe it or not, I still get these questions after all these years. I still get these questions. So let's talk about the debt to income ratio. So what I'm referring to when we say debt to your income, that ratio, your debt, the only debt that we're concerned about is what shows up on that credit report, right? And every now and again, there's some other nuances that don't show up on the credit report. I'll talk about that here in a second. But your debt to your income, your debt is the credit report, right? Your income is what we can verify that you actually get. How do you verify, Shirley? Well, we get the IRS involved. Yes, we do. Yeah. So basically what we'll do is we'll ask you for your written contracts, your pay stubs, your W-2s, and your tax returns, right? So whatever income that you are trying to qualify with, we need to make sure that income is being reported to the IRS. That's why I said, yeah, we get in touch with them. So we order a transcript, right? We as lenders order transcripts, right? These transcripts will show what you've accumulated and what you've reported as income. That's what's going to allow us to use this to qualify you against these debts, right? So if you are a W-2 wage earner, what we call you, right? W-2 wage earner, you go to work every day and you end up with a pay stub and a W-2. Easy breezy. We'll go ahead, make sure that's on your tax returns and we'll go on, right? Now, if you are self-employed, tax returns, tax returns, tax returns. Now, there are a lot of new lenders that are buzzing around. There's lenders that are still buzzing around from the old days, and there's new ones that are buzzing around that will allow you to use your bank statements. So this is a great program, right? And if you have any questions about wanting to know the bank statement programs, because there are bank statement programs. Yeah. Mm-hmm. And they're geared towards self-employed clients because we know with self-employment, there's ups and downs. So bank statement clients, call me. We have those programs. And understand, again, what are the three components that will drive that rate up or down? One of them is debt to income, or these bank statement programs will also have a little, what we call a hit to your interest rate, okay? Because they're not going to allow you to use these bank statements when someone over here has, W-2s and pay stubs that they really can verify. The bank statements are a whole nother breed, so the interest rates are just a tad bit higher. We'll talk about that later. If you need to use those documents, okay? There are what you say, Shirley? There are bank statement programs out there. Yes. For you self-employers. Yes. So let's talk about that. If you have questions about that, I'll be more than happy to go over those programs with you guys. But now listen, going back to this debt to income ratio, right? We verify. We verify income. Oh, yeah. So if you're a W-2, pay stub, wage earner, great. If you're self-employed, great with tax returns. Or if you have a bank statement program, we'll verify that as well. So now listen. Back to this debt to income ratio. The question that I get all the time is, Shirley, will my cable bill, will my phone bill affect my debt ratio? And I'll say no. The answer is no. Because if your cable bill, if your phone bill is not on this credit report, we don't care. We don't care. So your debt to income ratio, the debts are from the credit report, what we can see and verify on this credit report, right? Now, I do want to say this. If in the event that you've had a divorce or you have child support or you have, you owe the government, you're making installments to the IRS, sometimes this stuff is not on the bureau. However, every now and again, the payment may not show up on the bureau, but they'll say little words like collection, child support, or collection, IRS debt, or something to that effect, which will spark the underwriter's mind, and they'll go, hey, Where's that child support paper at? So when I say if it's not on the credit report, we really don't care, but do understand the underwriter is doing their due diligence, okay? And they will find out little stuff that sometimes you don't want them to find out, but they will. So again, we only take in consideration what's on the credit report. We don't take in consideration your car insurance. We don't care about that. Hopefully you have it, but that's not part of the debt to income ratio. The car insurance, the light bill, the cable bill, none of that stuff is comprised in the debt ratio. However, child support, owing the IRS, student loan, for some reason, if it's not showing up on the credit report, all of those things will matter with the debt ratio. But primarily, it's what they can verify and see on your credit report. That's the debt part of debt to income ratio, okay? So it's the debts. Now, the other question that I also get is the income side of it. Oh gosh, darn, my check, the only thing I brought home was, $3,000. That's all that I brought home. That's my net. So I guess I don't qualify, Shirley. Not necessarily, no, because guess what? The debt to income ratio, the income portion of that debt to income ratio is the gross. Yeah, we look at the gross income. So if you gross $6,000, but you only bring home $3,000, that's okay. We qualify you off of the gross, the $6,000, not the $3,000 that's your net. Okay? Huge difference, right? I've had clients that get so down and out, oh my gosh, I just don't bring home enough. That's okay. We're not using that dollar amount anyway. We're using the gross, right? So for your debt to income ratio, the debts that are on the credit report, the income that is the gross, that's what we use for your debt to income ratio. So I hope all that kind of made some sense for you guys, because you may qualify for more than what you really think. And let me tell you something about that income, though. Be very clear and understanding. When we ask you, how often do you get paid? It's not, I get paid twice a month. Okay, well, let's talk about this twice a month. Is it the 15th and the 30th, the 1st and the 15th? What is it, the twice a month that you're talking about? Or is it, right? Or do you get paid twice a month, 9 months out of the year, and the other 3 months you get paid 3 times? Because maybe you're on a bi-weekly. Maybe you're every 2 weeks, right? So just understand, some payments are calculated at 26 payments a year, right? Because when you're saying, I get paid twice a month, we don't want to count 24 months when you really get paid more than twice a month, because there's 2 months out of the year, I think it is. I think I said 3 earlier, but it's 2 months out of the year that if you're paid every 2 weeks, you're going to get 2 extra pay stubs. So it's not going to be 24 payments a year. It's going to be 26. And guess what? You're going to qualify for more house, right? With 26 payments, 26 paychecks versus 24 paychecks. So be careful about how you explain how you're paid, right? Although we're going to verify, we're going to do the verification of employment, the VOE. We're going to do that, but it's the upfront knowledge that you want, right? Especially when you're trying to qualify for your first time house. You're trying to buy your first time home or property, and you want to get qualified for the most you can get, for the most purchasing power. If you tell us that you get paid twice a month, we may not count 26 payments. We may only count 24. So be mindful of that. It's very important, because I get asked that question or get told that a lot. And then, but I thought I qualified for more. Well, I thought you got paid, 26. Okay. But you get what I'm saying though, right? Understand how frequently that you're receiving your paycheck. Is it every 2 weeks, right? Is it on the 1st and the 15th and the 30th? When do you get paid? Okay. So that, again, is very important when you're calculating your debt to income ratio, because I think some of you may be out there not qualifying for as much as you can when you want to buy your new property. So be mindful of that, okay? So again, with episode 24, we're talking about adjustable rate mortgages and refinancing. So this week in refinancing news, because if you guys, like I said, if you watch my previous podcast, you know I am pro what? Refinancing if there is a purpose, right? And if your purpose of refinancing is this: I am currently on an FHA loan that has PMI. What'd you say, Shirley? That has PMI, private mortgage insurance. If you're still currently using the FHA loan, there's nothing wrong with it. Don't get me wrong. Absolutely nothing wrong with it. But if you've been in your house for more than 3 to 5 years and you're still in this FHA loan and you have not refinanced out of it, you might want to call me. And let's talk about it. Seriously though, again, in this week of refinancing business, mortgage business, I've had a couple of clients, okay, that have FHA loans still to this day. We're closing out one today in about another minute or so. They close at 10 o'clock. So what I'm saying is this client had their FHA loan for, 2017. So 5 years. They've had that same FHA loan for 5 years. Why? Your house has oodles and oodles and oodles and oodles of equity right now. Get out of it. Because the one thing about FHA loans, and this will hold true for whatever FHA loan you think you're going to get from now until eternity, you will end up paying private mortgage insurance, PMI. And that private mortgage insurance does nothing for you, the homeowner, but it does everything for the lender. That's the insurance for the lender to make sure if you walk away, homeowner, if you walk away from this house, I'm going to be indemnified. I'm going to get my money back for what you did and walked away and not paying me this mortgage, right? So just be clear. If you are in an FHA loan right now, okay, and it's been 2 years even, 3, 4, 5, if it's been over 2 years, we need to talk. Because you don't have to continue paying that PMI. You know, here, especially in Los Angeles County, you know, where these properties are appreciating. Right now, after about 2 years, you very well could have 20% worth of equity in the property. And that's all you need to get out of that FHA loan, right? 20% worth of equity. Your loan to value only needs to be 80%. And you can refinance out of that FHA, get rid of that PMI, and get into a conventional. Now, I know what you're saying. My FHA rate is 3% right now. It's 2.5%. I get it. I understand. But let's talk about my client that's closing today, right? Loan balance, $305,000. FHA rate, 3 3/4, 3.75 is her FHA payment on $305,000 right now. We're refinancing, closing her loan today. And she's going from that 3.75 to a 4.99. What'd you say, Shirley? She's going from a 3.75 to a 4.99. And I know some of you people, some of you homeowners, soon to be homeowners, gonna be homeowners and investment owners, all of you in this mortgage real estate arena, you're probably thinking, oh my gosh, why would she trade her 3 3/4 rate for a 4.99 rate? Aha, PMI. That's it. You need to get rid of the private mortgage insurance. You've got the equity, get rid of it. And not only will your payment drop, which hers did, by the way, her payment is dropping by $200. That's $200 more you could be paying towards your principal balance versus to the lender, right? You're going to save that PMI payment, and let's call it, I can't remember what her PMI payment is, but let's just call it $200, right? So she's going to save that $200 PMI payment that she was once giving to the lender, and she's going to now put it to her principal balance. Daha! So now what you've done is you've given yourself $2,400 more every year that you could put towards your principal balance, or you could put towards your car loan, pay that off. You could put to some credit cards, pay those off. There's a lot you can do with $2,400 a year. So again, it may sound a little taboo to go from a lower rate to a higher rate when you have these FHA deals, but call me. And we'll talk about it because it just makes sense, right? And like I said, I get these scenarios throughout the week all the time because it just makes sense sometimes when you're refinancing with a purpose, right? Even if that purpose is just to get rid of the PMI, or a couple calls this week was, oh, I need to consolidate. I need to pay off these 19% interest rates on these credit cards that I have, okay? sometimes when you're refinancing on a purpose with the purpose, it just makes sense. Just makes sense. Even if the rate is higher. Like I said, in this market, we're saying that the rates are higher. Not high, they're just higher. So even if that rate is higher than what you're currently paying right now, it may make sense. It's refinancing with the purpose. It's a needs-based program, needs-based market. Get away, get it out of your head about these interest rates and get back down to the needs. You have the biggest investment, the biggest asset that you'll probably have in your lifetime if you're a homeowner or soon to be a homeowner. Use it. Use it. It's your money instead of someone else's money at MasterCard and Chase Visa or Wells Fargo MasterCard or somebody, whomever these other lenders are that you're using their money with their high interest rates that are not tax deductible. What'd you say, Shirley? They're not tax deductible. So instead of using their money, use your money, use your home, use your asset. That's it. That's all. I mean, I can't explain that any further. But again, guys, I strongly think that right now is still an opportunity to buy new property, to refinance if you have to. I got asked this question earlier today. I just kind of chuckled to myself. Hello, you're asking a mortgage broker, a real estate broker, you're asking me, is now a good time to buy? Of course it is. It's always a good time to buy if you have a purpose or if you're FICO score, your debt to income ratio, and what was that last thing I said? Maybe the other way around, but the loan to value, right? FICO score, loan to value, debt to income ratio. If all of these things are lining up and you have a income employment that you've been there at that same company for 2 years or more, that's a great time to buy, And sometimes you might even have to go out of state to buy a property. I only said that because I'm talking about myself. But seriously, folks, there's always a good time to buy. And I know some people say it's a buyer's market, it's a seller's market. What market is it? Well, we have just hit the height, the climax of a seller's market. And now we're starting it to be not so much of a seller's market, right? And even in the seller's market, that's what the naysayers would say, oh, it's not a good time to buy because it's a seller's market. They're going to be asking for too much. There's a lot of naysayers that say that about a seller's market. Those same naysayers may say that about a buyer's market. It's what you can afford and your purpose. Do you think it's a good time to buy? Because if you ask me, it's always a good time to buy. Instead of spending money on shoes, clothing, cars, think about it. If you're going to spend monies, right, buying anything, cars, shoes, clothing, right, that's thousands of dollars a month when you could invest in yourself, buy a house, and those thousands that you were spending on this frivolous stuff, you could be spending on a house that's going to appreciate. Okay, that's it. That's all. I wasn't going to hold you here too long. But again, I'm Shirley Nichols. It's Mortgage Money with Shirley. The podcast is twice a month on Fridays at 9:30 here in California. And I'd love for you to tune in, share, subscribe. What'd you say, Shirley? Subscribe to my YouTube channel. It's under Shirley Nichols. That's where you'll find all of these wonderful episodes. There's now, 24 episodes. And tune in, catch the replay. And like I said, I will leave you with this, my cell phone number, in case you didn't want to leave any comments in the Facebook page or DM me. My cell phone number is area code 818-720-7575. So call me and I promise I'll get back to you. And I hope that you have a wonderful, blessed holiday weekend. And until next time, it's Mortgage Money with Shirley. Thank you. Have a great weekend.